Hi again. Well, to close out this little information session on Silicon Valley Bank, there is another reason that this is not a banking crisis like 2008. And what happened in 2008 very clearly had to do with a lot of bad loans, a lot of bad mortgage loans. That's not the case at Silicon Valley Bank. It also had to do with the use of derivatives and a lot of leverage. Not the case with Silicon Valley Bank. In fact, there are very few comparisons between why banks failed during the financial crisis and why Silicon Valley Bank failed. And I think once people get a handle on that, they'll see that it's not systemic. It's this particular bank that was unique. And actually, I think because of technology, the sector that they've supported almost caused the run to happen. That brings me to my next point. When information is passed instantaneously, the way it was within the Silicon Valley Bank community, that can be a little bit scary. And it's something that I think we have to at least be aware of as a potential risk. Now, I think it's unlikely if you have a mega bank like JP Morgan that has many different kinds of depositors, many different kinds of businesses. Basically, it's a very, very large diversified bank that you would get a community of people instantaneously to cause a run on the bank. But what I am concerned about, and it hasn't really been talked about yet, are fintech, financial technology companies that have started apps for people to invest. Now, I think many of them, there are not banks. So if you're using one of these applications because it's cute, it's fun, it's an easy way to say pennies here, dollars there, you get points, I mean, whatever, you need to find out if that application is actually a bank and is FDIC insured. And I think many of them are probably not, and they are probably not SIPC insured because they're not broker-dealers. Now, they probably have affiliations with banks and affiliations with other broker-dealers, but I'm not really sure that in the moment SIPC or the FDIC is going to cover affiliated relationships to a bank or to a brokerage firm. But anyway, as more of these begin to proliferate, because some investors today think that they don't need anyone to talk to, they don't need a brick and mortar building, they can do everything online. What happened when Silicon Valley Bank failed? People stood in line at the brick and mortar bank because they wanted to talk to somebody. So I think there is a limit to how much we can expect any kind of protection when you're just doing your banking or savings or investing online without a broker-dealer behind it, without an FDIC insured bank behind it. So again, if you're using any of those apps, go to the apps. It should be very visible on the homepage, within their about us, what type of entity they are. So I'm going to close, but I think if you think about the markets in general and why owning a portfolio of all treasuries that went down in value was not because the Fed raised rates. I mean, that's kind of specious logic, I think, because market values went down for everybody. The final interesting question that we don't have the answer to yet is whether or not the Fed will continue to raise rates. Now remember, what is it the Fed is trying to do? I mean, they're not trying to cause people to lose money. This just happens. Rates go up, values go down, happens all the time. Happens every second of every day, in fact. Interest rates change all the time. There are price movements just like stocks, although most individual investors wouldn't see that. So interest rates change all the time. Should the Fed stop raising rates? Well, why are they doing it? I have to answer my own question. They're doing it to tame inflation. So if we think about the inflation we've all been suffering through, higher gas prices, higher natural gas prices for heating, higher food prices, higher car prices, you name it, it's been horrendous and it's been really difficult for many people. So the Federal Reserve does have an inflation target. It's around 2%. We're way above that right now. We're still at about 5.5%, 6% inflation. So if they pay attention to what I'm going to call it pundits are saying about, oh, we've had this big bank failure, the Fed caused it by raising rates, so they should stop because it's throwing the whole market into turmoil. I just don't think that's the right argument. Personally, I believe the Fed will continue to raise rates because what they're doing takes a long time to flow through to the economy. So raising rates last year is starting to work in terms of slowing the rate of inflation. And that's what we really need to see. If they stop raising rates, and actually there's something called a Fed Funds Futures contract, are showing that they could potentially lower rates towards the end of the year. What will that do? Well, it will definitely spur the markets. Interest rates come down, bond prices go up, stock prices go up, and if the economy starts picking up too quickly, too soon, what are we going to have? Inflation. So I think this is going to be interesting to see what happens. I'm going to put my money on the Fed raising rates at least one more time, 25 basis points. And in my video next month, we're going to see if I was right, if I was wrong, and what actually happened. Thank you so much for joining me today. I hope you'll visit the website, themodesteconomist.com. You can look for my articles, and as I mentioned before, hopefully I'll have just a simple sheet of resources for you so that you can click on the FDIC, you can see if your bank is insured, you can look up banks at the FDIC, you can look at the requirements for how much you're covered, the same with SIPC. And I also think using the US Treasury site, the Federal Reserve site, these are your trusted sources, not necessarily all the people who are talking and chatting. Anyway, thanks again. I look forward to seeing you next month.